In this video, I'm going to break down exactly what is selling puts and how can you use this tool to maximize your income. So in this video, my goal is to get you excited about selling puts, to give you a high-level understanding, see the value, and hopefully ignite your journey to becoming a master in this area. So first things first, what's selling a put? The world of options can seem very complex if you're first starting out. But the way I like to visualize this is literally you are writing a contract to the broader community of investors. And what are you doing in that contract? Number one, it's specific to a certain stock or investment. Number two, you're saying you're willing to buy that stock at a specific price. And that price is called your strike price. It's literally just a number, the value that you're willing to buy this stock for. And the third piece is the expiration date. This contract isn't good for forever. You're going to have an expiration date where this contract becomes worthless. So you can use this in such a valuable way to generate income in buying stocks for lower values in the future. So how does this work? So essentially, because you are willing to write this contract, right? This is what your selling put is. You're willing to sell this contract. Think about what value you're adding to the market. Someone owns the stock that you're willing to buy by a certain date. You're providing them almost an insurance policy. This person who owns the stock might be bearish and think, worried about my shares. If they go down, I need to make sure I don't lose my value, where they'll buy that put that you're selling to give them that relief that, okay, I know I can get out of this stock for this price because you're willing to buy it. This is a written contract. You have to do it. So doing that though, you collect what? You get money for that, right? You're almost an insurance provider but if you're doing this right, you're going to do it for stocks that you love and you're bullish long-term in, and you already hold long positions in for a strike price that you like the stock at. And you want to do it, be a little bit strategic about how long the expiration date is, and I'll talk through a couple considerations. So what did I just do recently? So to give you a concrete example, I love the stock Etsy. Etsy is one of my favorite stocks. I think long-term going to continue to accelerate and kind of take over the gift-giving market in America, which is a massive market because it lets you personalize so much things, and it's almost a different competitive advantage versus Amazon, which is more just general products and getting them for as low cost as possible. So what did I do? I wrote a contract. My stock was Etsy. I was willing to buy the stock at today's prices, which was around $220 at the time of this video. And I said, I'm willing to buy Etsy for $220 through expiring December of 22. So essentially I am saying if Etsy is still under $220 through the end of December of next year, I'm willing to buy it. And to me, I'm a long-term investor. If I can get this same stock Etsy for that deal over 365 days from now, please give me that, because I'll be more than happy to buy that stock, because I think the trajectory of this company and their revenue growth and their customer acquisition is going to continue to explode over the long term. So I'm writing a contract, and what happens? So to do this contract, you need to this is a guaranteed contract, you have to buy it. So what do you have to do? Other than collect the premium, which is the fun part, you have to provide collateral to your insurance, to your brokerage account. So you have two choices for collateral. You either have to essentially have your own cash being prepared to execute this contract, or you can use margin. Margin is essentially debt on your portfolio that you could use to buy these stocks. So how much money do you need as collateral? So what I should have clarified a little bit earlier is that these contracts are for 100 shares. They come in bundles of 100. That's what you're willing to buy. So in this case, you're willing to buy Etsy at $220. If you had 100 shares, which is the value of every single put option, that means you need to be prepared in this scenario to have $22,000, right? That's your collateral. And you can either have your money and sit in cash and essentially wait for that stock to come down, or you can use margin. So what is your percent return? So when I executed this contract early this week, I essentially, in premium, I collected over $4,200. And the beautiful thing about this is if you divide that by the 22,000, you're looking at roughly 20% on that collateral, because that's your technical return, assuming things go in your favor, meaning this contract will expire worthless by December of 2022, and I get to keep my premium in full, and I didn't need to exercise the actual put option. It expired worthless. So that contract goes to zero, you keep your premium, that's a good thing. And I think that's gonna happen because I love Etsy long term. So that's a 20% return. And now you have to decide, do you want to use your own dollars or margin? So if you're strategic, you can use margin because it's almost like free money in the world of selling puts, specifically there, because one of the things that I almost think is like a loophole, which is crazy, is that when you use margin, typically if I was to take out margin on my account, I buy stocks, I have to pay 8% right out of the bat, roughly, depending on how much you actually use on margin, but I'd have to pay it, the clock starts right away, right when I use margin to buy. But if you sell puts, you're not really using that money. So you don't accrue any interest on that margin unless this contract executed, you're at your expiration date, your stock is above your strike price, and boom, you have to actually pay that. The moment that contract would get exercised, then that margin's actually being used now to get those shares and now invest in it, and you have to hold that. So the fact that you don't have to actually use and start your margin and accruing interest, that's sort of like you're getting an infinite return because you're not even having your money cash just sit in your account not making a return for you and just collecting your premium, and now that money's locked up for 365 days or more than that, depending on the length of your option. So that's something to seriously consider. And one of the things people are most concerned about with margin is getting margin called. So if you think about this strategically, take the value of your account, and essentially what happens, you can get margin called when your equity, which is how much of your own money is in your stocks, falls below around 40%. So that's the magic number where if your equity, meaning your debt is 60% of your portfolio and your equity is falling to only 40%, that means that you're gonna have to potentially be forced liquidated, which you never wanna have happen as an investor. So how do you prevent that? Essentially set the amount of money that you're willing to use on margin to a very conservative number where you know in a worst case scenario, you're not gonna have to get margin called. How do you do that? So I would assume, me personally, I would say, hey, I'm going to divide the value of my account by 2. And I'm not going to let myself use more than 30% margin. So that means I stay above 70% equity, which means I have so much fluff because I'm assuming my portfolio is cut in half by a massive market correction. I lose over 50% of my portfolio, and my option exercises, I own those shares. And in that scenario, I am still over 70% equity in my account. So that's the number that you can do, or you find your own personal numbers to help you feel safe about avoiding a margin call, which is the biggest downside of getting that margin. So hopefully you got excited, because if you consider using margin for selling puts, you're literally getting an infinite return by agreeing to buy stocks in the future that you would love to own at a price that you are already happy with. So consider this. The last little fun tip I want to share with you, and thinking strategically over this, the expiration date. That's something that you want to be a little bit thoughtful about, because my general perspective is, if, for example, Etsy, if you look at their stock price over time, it's kind of at an all-time high. And if that's the case, I preferred a longer term, 360 days, right? Not till December of next year that this would expire. Meaning, if there's any market turmoil in the near term, in a year's time, I'm pretty confident that Etsy's going to make it through that. However, if it was a stock where it's been pounded, which is another one I just invested in, which was Lemonade, I sold a put on them when they were at $60 per share. And this is at one of the lowest prices it's been since IPO, like in the last year and a half, 2 years. So this is an already depressed price. So I am saying, I've already seen it, a significant turmoil. So I'm willing to go with a shorter term expiration date, because the turmoil's already happened. I'm at the bottom, I feel, the market of what a fair valuation for Lemonade is. So I don't have as much near-term volatility to worry about, assuming that, in my opinion, Lemonade, the downward movement was for no reason. It was just selling off of higher valuation companies. There's no bad news. So that means that I can collect my premium quicker, and I don't need as much time to let what's called theta decay work in my favor. So if it's moral of the story, something's very depressed and it's a near-term correction, I'm going to use a shorter-term expiration date to get in, get out of that contract and get my premium quicker. And if it's a longer-term opportunity, something I know is all-time high or near it, and it's going to continue, I think, to go on that trajectory long-term, I'm going to go longer-term expiration date, a year, whatever gives me at least a 20% return equivalent as if I was using that collateral. So hopefully this video did its job and gave you a high-level sense of what selling puts are, to help start your learning journey, to realize that you can use this to make a significant percent return in your portfolio and help you invest this money. Because what's the best part? The best part is that this premium you collected, you can invest it right away. The moment you sell this contract, right? My Etsy one, I put $4,200 in one of my other favorite stocks, Upstart, and that's going to generate a return, while I have the potential of buying more of my shares that I love in the future at today's prices. Give me that opportunity. So don't be too worried about options. Like, just start to learn them, because once you do, you can find opportunities to make a significant return and start building out your portfolio and making it that much more growth over the long term to help you reach financial independence for yourself. Thanks for listening to Live to Learn USA. Hopefully this helped, made some sense, got you excited. If you like this kind of content, feel free to like, subscribe, stay up to date with my latest videos, because I like sharing this stuff and hope you like learning. Take care.